You've done it. You've hit $100,000 in investable assets. This is one of the most difficult and important milestones in wealth building. And now the real question is, what do you do with it? Do you go all in on growth stocks and ride the bull market? Do you build a dividend machine for passive income? Or should you mix ETFs, stocks, and cash to balance growth and safety? In this video, I'm going to give you a step-by-step game plan for how to invest $100K in 2025 and 2026, including a diversified ETF-based portfolio you can copy today, honorable mentions of individual stocks to supercharge growth, how to balance growth and income during a Fed rate cut cycle, risk management and rebalancing strategies to protect your money. Stick around until the end. I'll also share an aggressive twist if you're aiming to turn $100K into $1 million as fast as possible. First, let's talk about why this milestone is so important. At $100K, compounding really starts to accelerate. At a 10% return, $100K grows by $10,000 in just 1 year without you adding anything. If you reinvest dividends, that snowball grows even faster. This is where your portfolio starts to outgrow your annual savings, and that's the tipping point where wealth begins to build almost on autopilot. But this also means every decision you make now, every ETF, every stock, every sector tilt, has a much bigger impact on your future net worth than when you were just starting out. The timing is also very interesting. The Fed just cut interest rates by 25 basis points and has signaled as many as 5 more cuts between now and the end of 2026. Historically, this is a bullish signal for stocks. Since 1980, the S&P 500 has returned an average 14% in the 12 months after the first rate cut of an easing cycle. Over the full easing period, markets have returned 25 to 30% on average. Rate cuts make borrowing cheaper, boost corporate earnings, and push investors out of cash and bonds and back into equities. But this doesn't mean blindly buying everything. It means allocating smartly to growth sectors while protecting against volatility. This mix lets you ride the market rally while still collecting dividends and income along the way. The 40% growth slice gives you exposure to tech, AI, and innovation, which historically outperform after rate cuts. The 25% dividend ETFs give you stability and consistent payouts you can reinvest. The 15% covered calls smooth out volatility and keep monthly cash flowing. The 10% international allocation takes advantage of attractive valuations in Europe and emerging markets. The final 10% in cash/bonds gives you optionality. If we get a correction, you have funds ready to buy the dip. Now, if you want to spice things up, here are a few individual stocks worth considering for 2025 to 2026. Microsoft, MSFT, a leader in AI and cloud computing, consistent revenue growth, strong balance sheet. NVIDIA, NVDA, the backbone of AI infrastructure, still a long-term secular play. Apple, massive ecosystem, share buybacks, and potential in AR, VR, and services growth. Tesla, TSLA, EV market leader, energy storage and AI autonomy optionality. Johnson & Johnson, J&J, defensive healthcare play with steady dividends. Procter & Gamble, PG, consumer staples anchor, low volatility, recession resistant. Limit your individual stock exposure to 10 to 15% of your portfolio max, unless you are comfortable with higher risk. If this $100,000 portfolio earns 8 to 10% annually, here's what it could look like. And that's without adding any new contributions. If you're still adding $1,000 per month and reinvesting dividends, you could be looking at $150,000 plus in just 2 years. This is why staying invested and reinvesting income is so powerful. The snowball keeps getting bigger. Even with a strong plan, risk management is key. Rebalance every 6 months. If tech runs too hot, trim some gains and rotate into income or cash. have a 3 to 6 month emergency fund separate from this portfolio so you don't panic sell in a downturn. Avoid overconcentration. If one sector is more than 40 to 50% of your portfolio, consider trimming. Watch fees and taxes. Keep ETFs with low expense ratios. If your goal is to turn $100,000 into $1 million as fast as possible, here's a more aggressive version of the portfolio. 60% growth ETFs, QQQ, SMH thematic AI semiconductor ETFs, 20% dividend ETFs, 10% small caps or emerging markets, 10% covered call or income. This gives you more upside potential, but expect more volatility and be ready to stomach 20 to 30% drawdowns along the way. Now let me show you a bonus portfolio build, one focused purely on ultra-high-yield covered call ETFs. Here's how I'd allocate $100,000 across a mix of covered call ETFs and one stock position, along with the dividend yields you could expect. 35% in QQQI, 30% in SPYI, 20% in JEPQ, 10% in BTCI, and lastly, 5% in TSLA. The total projected annual income for this portfolio build will give you $13,285 per year based on current yields. That's over 13.2% yield on the full 100K portfolio. This build is designed to generate maximum monthly and quarterly income. At today's yields, this portfolio could generate around $13,285 a year in dividends and distributions. That's over $1,100 every single month. Of course, the trade-off is that covered call ETFs cap your upside in strong bull markets, and funds like BTCI, which is tied to Bitcoin options, are very high risk. Before we wrap up, a quick disclaimer. I am not a licensed financial advisor. This video is for educational and entertainment purposes only and should not be considered financial advice. Every investment carries risk, including the risk of loss. Always do your own research and consult with a licensed financial professional before making investment decisions. So there you have it, a 100K portfolio strategy designed for the 2025 to 2026 market environment. Whether you lean more toward growth, prefer steady dividends, or want a mix of both, the key is staying invested, rebalancing smartly, and letting compounding do the heavy lifting for you. If you found this helpful, give this video a like and subscribe for weekly investing breakdowns. And let me know in the comments, if you had $100,000, how would you invest it today? Growth, dividends, covered calls? I want to hear your strategy.